Yonghao, Chief Investment Strategist for Asia Pac at UBS Wealth Management. Good to have you with us. Increasingly, people are saying they're not expecting anything. Forget expecting anything from Ben Bernanke this time around.
Right.
Do you share the view?
Well, I think probably the probability is low at the moment, but I think Bernanke probably will sort of hint that he's ready to use further stimulus if economy deteriorates, particularly job market. I think he's number one concern. I mean, look at the moment, the job market has no sign of improvement. Yesterday, just a jobless claim increased again. I mean, this is probably can open the way for further stimulus. Maybe he's not going to announce today, but then he probably will say he's ready to roll out.
Is that the best case scenario? I know some people have indicated that that will be the best case scenario, but will it be enough for the equity markets, which are expecting perhaps, further stimulus?
Well, yes, equity market probably not only look at the Jackson Hole speech, but also look at the real economy. I think this is dominating what's going on in the equity market. Recently, equity market has been coming down, largely due to the weak economic sign. I mean, you look at the leading indicator, jobless claim, look at the housing index, and so on, all pointing a slower growth, if not into recession. But I would say people are concerned the probability of recession has been increased.
And of course, that's leading to a lot of volatility. How do you trade in such times? Where do you see opportunity?
That's a good question. We advise our client take a sort of defensive position in terms of you take some more defensive in terms of like holding a bit of the more emerging market sovereign bond, holding a bit of a corporate bond, increase cash portion. Within the equity probably you need to increase a little bit of more defensive sectors such as telecom, utility, consumers, which I mean aggressive investors still can use a bit of long on the volatility, prepare the further sort of the volatility in the market.
And of course you need some gold in your portfolio, no?
Definitely, gold is a kind of insurance. Not necessarily you can earn a lot of money from gold, but it's insure against the potential quantitative easing. If the worldwide central bank is printing a lot of money, then your insurance is going to hedge you for potential inflation.
Is this a good time to be buying into gold? We're seeing some correction.
Yes.
For the yellow metal.
Well, we are expecting probably in the 3 months goes to like 2,200 per ounce, but obviously it's basically direction we are calling for the further sort of upside for gold in the short term. I think we are not saying that you should put all the money into gold, maybe 5%, but I think it's a good chance to have accumulated some if you don't have yet. But of course, if you already have some, you don't need it to.
Why don't you like silver? You say stay away from that metal.
Well, silver is a bit more volatile because the ratio versus gold seems a bit traded too much. I mean, there is a constant ratio between the gold and the silver price. And right now we look like the silver has been a bit of a more speculative, while the gold is relatively sort of stable in terms of reflecting more fundamental, while the silver is more speculative.
All right, Yonghao, we'll have to leave it there.